Imagine fighting this brutal, just multi-year legal war against the federal government.
Sorry.
Like, for years, you were labeled a rogue asset, right?
Yeah.
Just entirely radioactive to the traditional financial system.
Oh, completely. Like,
Yeah.
untouchable.
Yeah. If anyone on Wall Street even looks at you, they get a knock on the door from regulators. But then, seemingly overnight, not only does the government drop the charges, but Wall Street immediately hands you, like, a VIP black card.
Yeah, they invite you straight into the most exclusive country club they have.
Exactly. So welcome to the deep dive.
Yeah.
If you're listening to this, you are someone who wants to understand, really, the absolute biggest financial shifts happening right now. And you want to do it without drowning in an ocean of crypto jargon because, man, there's a lot of it.
There really is. And, we are stripping away the noise today to look at the actual underlying mechanics of a genuinely historic transition.
Right, because today is March 26th, 2026. We were sitting just over a week out from a massive turning point. And our mission today is to figure out how XRP went from being this deeply polarizing, legally embattled token to a mainstream regulated financial instrument. I mean, almost overnight.
It really was fast.
We are looking at a complete paradigm shift in real time.
Yeah.
We've got this great article we're pulling from today, the XRP ETF era, what you need to know in 2026, and it lays it all out.
And what's fascinating here is that this isn't just a story about a token's price going up or down. That's what people usually focus on.
Parts.
Right. But we are watching the rapid, real-time professionalization of an entire asset class. The broader question we need to keep in mind today for everyone listening is this: when a decentralized anti-establishment technology gets completely absorbed by the traditional financial system, who is actually winning?
Oh, that's a great question.
Right. Like, is this a victory for crypto, or is Wall Street just, swallowing it whole?
Yeah. Okay, let's unpack this. Because to grasp how massive this new era is, we first have to understand the absolute regulatory wall that kept traditional money out for so long.
It was a massive wall.
Huge. For years, XRP was plagued by the dreaded unregistered security label. And for listeners who follow this, holding XRP felt like walking around with a suitcase of legally questionable cash.
That's a great way to put it.
You never quite knew if the authorities were going to seize it or tax it into oblivion or just declare it entirely illicit. But then, on March 17th, 2026, we got a historic joint classification from the SEC and the CFTC. They officially deemed XRP a digital commodity.
Which is huge. That distinction between a security and a commodity is, well, it's the entire ballgame.
Right.
It's not just a semantic label. It is a strict mechanical set of rules. When an asset is classified as an unregistered security, it is essentially placed under financial quarantine.
Quarantined how, exactly?
Yeah. Well, traditional banks and asset managers have these hard-coded compliance rules, right? They literally cannot touch an unregistered security without risking just devastating fines and legal liability. It's a non-starter.
Wait, can we break down why that label is so toxic? Because I think people hear security and they just think of stocks, which Wall Street trades all day long. Why is an unregistered security the kiss of death?
It really comes down to disclosure and control. So a security, like a share of Apple stock, for instance, implies that you are investing money into a centralized enterprise.
Okay.
And you're expecting a profit based entirely on the efforts of that company's management team.
Right, like Tim Cook doing a good job.
Exactly. And because of that power dynamic, the law requires massive standardized disclosures, quarterly earnings, risk assessments, audited financials. That way investors aren't getting scammed by the insiders.
Makes sense.
So if you issue a token that acts like a stock, but you don't register it and you don't provide all those disclosures, the SEC considers it strictly illegal.
Wow. Okay, so by calling it a digital commodity on March 17th, regulators are basically saying, actually, this behaves more like gold or wheat.
Yeah.
It's just a raw asset.
Exactly the right framing. I mean, nobody expects a quarterly earnings report from a bar of gold.
Right? Gold doesn't have a CEO.
Exactly. The value of gold is dictated purely by market supply and demand. By officially moving XRP into that digital commodity bucket, the SEC and CFTC didn't just end some philosophical debate. They completely removed the foundational barrier to entry.
They stamped the passport.
Yes. They told compliance departments across the globe, this asset is clear.
It's the green light Wall Street was waiting for. Which brings us to the immediate explosive aftermath of that March 17th milestone. Once that regulatory red tape was cut, the floodgates completely blew open.
They really did.
We saw the immediate launch of spot ETFs from just absolute giants. We're talking about Franklin Templeton, Bitwise, Grayscale. These aren't scrappy little crypto startups.
No, these are the titans of traditional asset management, the old guard. And the speed of that rollout honestly tells you everything you need to know about the pent-up institutional demand. But we should probably clarify what a spot ETF actually does for the ecosystem, mechanically speaking.
Yes, let's ELI 5. Explain it like I'm 5, because the term spot ETF gets thrown around constantly. How does this actually change the way a normal person or, a pension fund interacts with XRP?
Sure. So before these ETFs, if you wanted to invest in XRP, you had to interact natively with the crypto ecosystem.
Which was a headache.
A massive headache. That meant signing up for an often unregulated crypto exchange, wiring your money there, and then if you actually want it to be safe, transferring that crypto to a physical hardware wallet.
Right, the little USB things.
Yeah. And you had to physically manage your private keys, which is basically a string of cryptographic words that act as the single only password to your money.
And if you lose it?
If you lose that piece of paper, if a hacker gets it, your investment is gone forever. I mean, there's no 1-800 number to call. There's no fraud protection.
Which is completely terrifying for the average retail investor, let alone a multi-billion-dollar retirement fund.
Yeah.
Like you can't have a teacher's pension fund relying on an intern not losing a USB stick.
Precisely. It's just unacceptable risk for them. So a spot ETF acts as a translation layer. Spot just means the fund manager, like a Franklin Templeton, goes out into the open market, buys the actual underlying XRP, and locks it inside an institutional-grade, fully insured digital vault.
Okay, so they hold the real token.
Yes. And then they issue traditional shares that simply track the value of the XRP sitting in that vault.
So for you, the investor, you just log into your standard brokerage app right next to your index funds, your tech stocks. You type in a ticker symbol and click buy.
Exactly. You get complete exposure to the price movements of the asset, but the Wall Street firm handles all the terrifying cryptography and custody behind the scenes. It completely removes the friction.
And the money poured in through that frictionless pipe immediately. But I actually have to pause here because I was staring at the numbers from the days following the March 17th announcement, and I'm genuinely confused by the math in the article. I need you to explain this.
Sure. What's the hang-up?
The data explicitly notes over $1.4 billion in net inflows into these new funds since they launched. But then right below that, it lists the combined ETF assets under management, the AUM, at over $1.02 billion.
Right.
How can you pour $1.4 billion into these funds but only have $1.02 billion sitting in the accounts? Did $400 million just vanish into thin air?
Yeah, it looks like a glaring error on paper, but it's actually a perfect illustration of how market mechanics work during volatile periods. Let's use a real estate analogy.
Okay, I love a good analogy.
Imagine you and a group of investors pool together $1.4 billion in cash. That is your net inflow. You take that cash and you buy $1.4 billion worth of houses in a specific neighborhood.
Okay, I have $1.4 billion in houses.
For a day or two, yes. But then, let's say a week later, the overall housing market in that entire city drops by roughly 25%.
Oh, I see where this is going.
Right. You haven't lost any of the houses. You still own the exact same number of properties. But if you were to appraise all of them right now, the total value of your portfolio is only $1.02 billion.
Okay, so the asset managers bought $1.4 billion worth of XRP, but the actual market price of XRP went down after they bought it, which dragged the total value of the fund down with it.
That's it. It's a phenomenon called market depreciation eating your capital inflows. You can pour water into a bucket as fast as you want, but if the bucket itself is expanding and contracting based on market prices, the volume you measure later might be smaller.
That makes perfect sense.
But, we shouldn't let that math quirk distract us from the broader signal here. Big money players are aggressively stepping in. They're treating this as a foundational portfolio allocation now.
Which is an incredible transition. But that realization brings up the great paradox of this whole situation. And I think this is the thing that might be confusing a lot of listeners right now.
Let's hear it.
So what does this all mean? If billions of dollars are flowing in from massive Wall Street institutions, and the years-long legal battle is finally won, and the regulatory clouds have completely parted, why did the price drop?
It's the multi-billion-dollar question, honestly.
Right. Why isn't the price of XRP absolutely skyrocketing right now?
Yeah.
It's like buying a house in the hottest neighborhood, but the overall economy is so shaky that the house's value is dropping anyway.
Yeah, investors naturally expect that if you remove a massive roadblock, the car should instantly accelerate to 100 miles an hour.
Exactly. But the reality check on the price action is pretty stark. Back in July 2025, following the initial rumblings of a legal settlement, XRP hit a record high of $3.65. Fast forward to right now, March 2026. Despite the ETFs launching, despite the joint SEC and CFTC classification, the price is sitting around $1.42.
It feels completely counterintuitive.
It really does.
But to understand why, we have to look outside the crypto bubble. The asset itself is structurally sounder than it has ever been, but the neighborhood it lives in is enduring a severe storm right now.
Macro pressures.
Exactly. We're looking at overwhelming macroeconomic pressures. The broader global economy is acting like a giant wet blanket on all risk-on assets.
So, mechanically speaking, how does a macroeconomic pressure actually force a crypto price down?
Let's look at the primary driver: high interest rates. When central banks keep interest rates high, they make borrowing money very expensive.
Right.
In traditional finance, risk is entirely calculated against the risk-free rate, which is essentially what you can earn just by leaving your cash in a secure government bond.
Okay, so a guaranteed return.
Exactly. If a wealth manager can get a guaranteed, totally safe 5% return from a treasury bill, the hurdle for taking a risk on a volatile asset like cryptocurrency becomes incredibly high.
Oh. They don't need to chase wild returns because they are getting paid nicely just to sit on cash.
Exactly. Add in geopolitical tensions, which create fear and uncertainty globally. In times of uncertainty, capital naturally flows away from volatile tech and crypto investments, and it hides in safe havens.
Like the US dollar or gold.
Right. Institutions just go into a defensive wait-and-see mode.
It's the gravity of the real world pulling the crypto market down to earth.
And ironically, this proves that XRP has achieved the mainstream status it was fighting for all those years.
Wow, so.
Well, back in the day, crypto prices moved in a total vacuum, driven entirely by Reddit threads, Twitter hype, and community sentiment. It was an isolated casino. Now, it is tethered to the exact same macroeconomic gravity as traditional stocks and commodities.
Wow.
If inflation is sticky and the Federal Reserve is hawkish, XRP feels the pain just like the NASDAQ does.
So professionalization comes with the pain of traditional market cycles.
It does. It really does. And with that integration comes the brutal volatility that technical analysts constantly monitor. We are seeing a market environment right now that analysts are actually comparing to the massive flushes of 2018. Yeah. When institutions pull back their capital, the market depth thins out. Right now, traders are obsessively watching a critical support level at $1.12.
Okay, let's translate support level for the audience. That's
Yeah.
basically the floor where buyers historically step in and say, okay, it's cheap enough, I'll buy, which stops the price from falling further, right?
Yes. It's a psychological and mathematical floor. If the macroeconomic pressure forces the price to break below that $1.12 floor, algorithms and traders often trigger automatic sell orders.
Just to protect themselves from further losses.
Exactly, which can weaken the entire technical structure of the asset, regardless of how much long-term ETF money is slowly trickling in.
Man, it's a tightrope walk.
Yeah.
You have the institutional capital acting as this long-term safety net, but the short-term macro winds are just violently pushing the walker around.
It's a very tense moment.
But here's where it gets really interesting, because external macro pressures aren't the only headwinds. As I was digging through the article and our research, I noticed there's a fascinating internal competition brewing. It's almost like a threat from inside the house.
This is perhaps the most nuanced part of the 2026 landscape, honestly. Ecosystems evolve, and sometimes that evolution creates a scenario where a company might accidentally cannibalize its own product.
Yeah, let's talk about RLUSD. So Ripple, the company closely associated with building the infrastructure for XRP, recently launched its own stablecoin called RLUSD.
Right.
And for years, the fundamental sales pitch for XRP, like the reason it existed, was utility in cross-border payments.
That was the whole dream.
The idea was that if a bank in Japan wants to send money to a bank in Mexico, instead of going through a slow, expensive correspondent banking network, they could convert their yen into XRP. Then they send the XRP across the world in 3 seconds and convert it instantly into pesos. Fast, cheap, international transfers.
That was the foundational use case, using XRP as a universal bridge currency.
Right. But now, Ripple has RLUSD, which is a stablecoin. Can you quickly explain the mechanism of a stablecoin and why a bank might prefer it?
Sure. A stablecoin is a cryptocurrency that is permanently pegged one-to-one with a fiat currency. in this case, the US dollar.
Okay.
So one RLUSD will always equal exactly one US dollar. It achieves this because the issuer holds actual verifiable US dollar reserves in a traditional bank account, backing every single token they mint.
So it completely eliminates the volatility.
Entirely. And think about this from the perspective of a risk-averse compliance officer at a massive global bank.
Okay.
If you are moving $500 million from Tokyo to London using XRP, the transfer might only take 3 seconds. But in those 3 seconds, the price of XRP could theoretically drop by 0.5% in a volatile market.
Which, wait, 0.5% of 500 million is a $2.5 million loss?
Yeah.
Just in the time it takes the money to cross the internet.
Exactly, a completely unacceptable risk for traditional banking. But with RLUSD, they get the same blockchain speed, the same 3-second settlement, but with zero price volatility.
Wow.
They're just sending digital dollars.
This is blowing my mind. It's like Apple creating an iPad that is so incredibly powerful and versatile that people simply stop buying MacBooks.
That's a great analogy.
Like, why would a financial institution ever choose to use the volatile XRP token for a massive transfer if Ripple is offering them a perfectly stable digital dollar on the exact same high-speed network?
This raises an important question, and it's really the existential crisis at the heart of the asset right now.
Yeah.
We are looking at a profound fundamental tension.
Yeah.
On one side, you have this massive financial scaffolding being built around XRP. The Spot ETFs, the SEC and CFTC commodity approval, the billions in institutional inflows, it is fully professionalized.
It's totally legitimized.
Right. But does any of that financial scaffolding matter if the core underlying utility of the token is fundamentally replaced by a stablecoin designed by the very same ecosystem?
It's the ultimate irony. They fought the law, they won the commodity classification, they got the Wall Street wrapper, but they might be out innovating their own token's primary use case.
It forces the market to ask a very difficult question. What are we actually valuing here?
Right.
Are investors buying the XRP ETF because they believe it's going to be the indispensable bridge currency for global banks? Or are they just buying it because it's an approved, regulated ticker symbol with strong historical brand recognition in the crypto space?
Basically, is it a technology tool or is it just a digital collectible at this point?
Exactly. If RLUSD handles the actual utility of cross-border transfers, XRP's value proposition shifts dramatically. It moves away from being a utility token, something valued because it performs a specific task, and becomes something closer to a speculative store of value, much like the debate that has surrounded Bitcoin for years.
That is a staggering pivot. It means the narrative for the rest of 2026 isn't just about whether the Federal Reserve lowers interest rates so the broader economy recovers.
No, it's bigger than that.
It's about whether XRP can redefine its entire identity in a world where stablecoins exist to do its original job better.
It's a harsh reminder that regulatory clarity doesn't guarantee technological dominance.
Ooh, that's a good point.
The rules of the road are finally clear, the police have stopped pulling them over, but the vehicle itself might be becoming obsolete.
So, bringing this all together, what is the bottom line for you, the listener? We've covered massive ground today.
We really have.
We look at how the unregistered security quarantine was finally lifted by regulators, allowing XRP to be classified as a digital commodity. We unpack the mechanics of how spot ETFs function as a translation layer, allowing traditional Wall Street pensions to pour billions of dollars into the ecosystem without having to manage terrifying private keys.
And we also explored the paradox of market depreciation, how macroeconomic forces like interest rates are acting as gravity, suppressing the price despite massive institutional adoption.
And finally, we looked at the threat from inside the house. How the rise of stablecoins like RLUSD might solve the volatility problem for banks, but create an existential utility crisis for XRP itself. The core takeaway from everything we've looked at today is that XRP has definitively crossed the Rubicon.
Unquestionable.
It is no longer just a rogue, community-driven token operating in the shadows of the internet. It is a regulated, institutional financial instrument.
The asset has matured, and the infrastructure has matured alongside it.
But the defining narrative of 2026 will be whether its actual market value can ultimately catch up to this massive fundamental progress while surviving its own technological evolution.
Right.
You should care about this because it isn't just a story about one specific cryptocurrency. You are witnessing the exact blueprint for how the traditional financial establishment co-ops, digests, and sanitizes the very technologies that were originally designed to bypass it.
That's a really powerful way to frame it. And if we connect this to the biggest picture possible, it leaves us with a fascinating philosophical paradox to consider.
Lay it on us.
Think about the origins of the cryptocurrency movement. It was born out of a desire for decentralization, a way to operate outside the control of massive banks and government regulators.
The whole cypherpunk dream.
Exactly. But now, XRP is neatly wrapped in a spot ETF. It's held in custody by massive Wall Street asset managers, integrated into traditional brokerage accounts, and officially blessed by the SEC and CFTC.
It's part of the machine.
It is a machine, so does it lose the very anti-establishment ethos that gave it value in the first place? If a revolutionary digital asset simply becomes just another ticker symbol sitting in a retirement portfolio next to traditional corporate bonds and index funds, we have to ask, has crypto conquered Wall Street, or has Wall Street simply conquered crypto?